It's just 2 o'clock and we have a couple of participants joining. I hope some more will come in, but nevertheless, I think we just start with the very beginning that some of you might already know, and if others jump in, we will just take them on. So welcome everybody. Thank you for joining this very last webinar on a series of the topic from the idea to the investor. My name is Alexandra. Some of you may know me already. I'm leading you through this webinar and will discuss with you today the topic of how to approach investors. Just some organizational issues. We will have about 45 minutes of presentation, and then we'll have the chance to ask questions via the chat function that you can see, and we'll take about 15 minutes for that. As you have already seen, the topic today is how to approach investors, and we will jump right in our agenda. And as you can see, I want to talk with you about just a brief introduction of the Empowering People Network, FASE, and the definition of investor that we would discuss. We will then jump right into the topic of the investment process, the question of how different potential investor groups are set up, and also what you need for a good preparation if you want to start your investor approach. We'll just sum up with some key learnings that might be helpful for you as takeaways and getting you started. Now, why are we actually able to do all this? It's because of the Empowering People Network, which is founded by the Siemens Foundation. And the idea of the Empowering People Network is really, as you can see here in the 5 setups, is to bring people together, to provide solutions that can be seen by other people, to bring in expertise in all of your heads, to provide tools and resources, to bring partnerships together. So basically to help all of you out there with good ideas in social entrepreneurship, to improve, to get networks, and to actually grow bigger with your idea. And in a cooperation with the organization I am working for, we've built up this whole webinar and the accompanying blogs and the sections that we want to provide you to for your further work. So FASE, the organization I'm working for, is the abbreviation for Financing Agency for Social Entrepreneurship. As the name already suggests, we're working in the field of social entrepreneurship and are a 100% daughter company of Ashoka, that some of you might know as the biggest network of entrepreneurs worldwide. We as FASE are looking for the one to change the system, and that's something that's quite an approach, I know, and we try to help social entrepreneurs get access to working and financial capital. And in that context, we work with both sides, so the investors and the social entrepreneurs, in finding the right financing situation and getting through the whole process of this investing. So basically what we do is building bridges between the social entrepreneurs and investors, and in that function I've seen quite some companies that are looking for growth capital and work with both sides, so hopefully I can give you some of my insights of the work that we experience. Just before we jump in the topic, I want to start, as I said, with just having a closer look at the term investor and what we actually mean by it. All of you probably have some definition in your head, and there's always something that comes up to you if you're thinking about an investor, but I just listed some main characteristics that we take as trigger words here to work with. So of course, the most important part of an investor is that he or she provides money and potentially network. We will come to that at a later stage. There will always be a question of some kind of return, and that's an expectation that depends on the investor, and in fact it depends on the investor what the return actually encompasses, whether it's financial or otherwise driven. There will usually be something and an investor that he will scrutinize your business, so look in the very detail and will want to understand what you do and how you do it, because that's of course a major part of understanding and judging the risk on your business. At one point, he will hopefully be able to understand and also drive forward your business, so also function as some kind of sparing partner to provide you some input. And usually should have an interest in your topic. So whatever you're doing, it will most likely be something that touches your investor at one point or the other. Because of all the opportunities investors have, they usually choose the ones that are closer to their mind or their heart. They should ideally and most often do enjoy bringing companies forward. So especially in this startup section and social startups where companies are young and still have a long way ahead, it's most often investors that want to or like working with these young companies because that's something very different to older companies. And as an extra for social investors, they usually should understand the difference between startups and social startups, because despite the many similarities that they have, you know the best that there are also some quite big or differences, and a social investor should most likely be able to understand. So in what ways investors can differ, what they expect, and why all of this is relevant for your investment approach is coming up now in the following chapter. So let's look again at a symbolic figure here that you might know, and that could be a figure that represents you maybe in the present or in the near future, asking yourself, what do I actually need to do when I approach investors? Typically, it's a question that you ask if you have somehow a running business which is close to generating first revenues. It's not a must, but it's typically the point. You have started preparing some professional documents and they show what you've achieved, where you want to go. So you have some kind of a history to show and also a plan to go ahead. And that's the reason you need fresh money, because you want to keep the business alive, let it grow and continue further. What you want to have then on the other side is to find out what networks actually, what networks and what investors exist. You want to prepare for the process, and you want to be able to avoid any pitfalls that you can, because you know it's a long way and you want to be good at it. So before you even start with any process, really, it's important that you know what you should expect and also prepare accordingly. That's why we start right now with just a rough time schedule of an investment process here. The very first point of the investment process is really the preparation of your financial plan and calculation sum. That's where you collect all your financial expectations. You have a lineup of your revenues, your costs, your investments. So everything you plan, you put them down in financials, and you use that to identify your cash need. So the cash need is not really a figure that comes up at the tip of your head, but it's usually and should be something that comes out of a calculation where you put on everything that you want to do and then look what it costs. Of course, as you will understand, this should be ambitious because you want your plan to be, showing your dreams and also where you want to go. But it also should be realistic. So dreams are okay, but dreams should also be manageable. So finding something in between will bring you to your investment sum. In the second step, what follows usually up is the preparation of the business plan and pitch deck. The business plan or pitch deck, or you can have either or, you can have both. It's usually containing the business model, the achievements, a very structured presentation of your company and what you've done and where you want to go. There was also the previous webinar, number 3, on the question of how you structure your business plan and good examples of a business plan. So maybe if you want to go on the previous recording of that and take some of the ideas out, that might be helpful for you when you are still at the point of preparing your business plan. Usually in the following up is the identification and approach of relevant investors. That is something that we will cover up in the following pages, so I don't want to spend too much time here, but it's basically the idea of finding investors, approaching them, giving them first pitches of your company and then continuing the talks. Especially this pitching and continuing the talks is something that's in the very structured orders or sequences, usually summed up as in the term management presentation. So management presentation is the point where you meet them, where you have an introduction. With your presentation, you have the ability to share your ideas, and in return are being asked questions by the investors who want to get to know you better, and you are generally interested in your company, but want to see if they want to continue. This process also helps you in the presentation to identify strengths and weaknesses in your business model, and on the one hand, and on the other hand, in the way you present it. So it's really good also for you to see, okay, what are the questions, for example, that are being asked by so many people. Maybe they have a point in asking that, and maybe there's something that I need to change in my system. Follow up by that is the process of the due diligence and further meetings. This is mostly due to the fact that some investors, not all of them, but some of them will not be fine with just one presentation and then their agreement to give you money, but most often they want to dive deeper. They want to get a better understanding. They most often want to see more financial figures. For example, if you have a history to show, they want to see how details on your previous earnings, etc. And they want to do all of this because at the end they want to improve the trust and the certainty and want to reduce risk, because whatever risk they have, they will probably keep them away from investing in you. Followed by this is usually the negotiation part. So when they have come to a positive agreement and positive understanding of your business, you will go into details of negotiating what their expectations are and what your expectations are. This is very typical and usually ends at either directly a term sheet, which is a summary of the main points, or a contract. The contract is the very last and very legal document, and the term sheet is often put together to just contain the main points that you are discussing, and that is being done in rather a bullet point style and not so much a legal language. So it's something where you can basically sit down and write down, okay, we want and we agree to have this, this, and this, and we're fine on this, and we agree on this. And then you basically have your deal, but you then translate it into a legal language, and all the contract works around it. But that usually takes a little more time. That's why you, before you take all this time of going to the legal process, you often sit together and say, okay, we want to be sure we're on the very same page. So we first do this term sheet, and then if we see this works perfectly fine and we both know where we want to go, then we transfer it in the legal contract. And at the end of the process, you come up at the point where you have the signing and closing. Signing and closing for you usually is the same date and same occasion. In a bigger company context, it can be different in time, because the signing is actually the signing of the contract, whereby the closing is the transfer of the money. So that can be some weeks or months difference, but for you it's mostly very closely related. How long does this process usually take? Very difficult to say. For some it can be very short and very quick. For some it can be very enduring and even more than a year or longer. I wrote down here around 6 months, because that's the average that, or not the average, but a good estimation of what we see and the companies that we work with. And it's actually also quite depending on the different investors. And that's, for example, in the process of the due diligence. So this whole looking up very deep in your figures, etc., will usually be much longer for some people than it will be for others. We will touch upon that later on, but that's an example of where it can take either a week or 3 months. So now that we have seen this process, I just want to give 2 examples as a sneak in on the investor side, and how this time schedule can actually depend on the attitude. You can see it's two examples here of quotes, the one by Bill Gates, the other by Brian Tracy. And Bill Gates quotes that in some ways, if you make mistakes with your own money, you don't feel as bad about it as if it was someone else's. Suggesting that the difference here is quite big if you take the decision for someone else or for your own, which is understandable and also a reason why some of them take longer than others. The other one is basically hinting at the fact that the whole investigation part is for some people very, very important because they feel they have to know every single detail of a company before investing. For other people, it's really more like a gut feeling, and they say, I need the team, I like the idea, and it's anyway risk money, so I'm just gonna get it in there and see what happens. So at the end, it's really a lot about the individuals and characteristics, and that's something that we will discuss later. So now that we know the process and the steps that we are expecting, I think it's quite useful if you are considering some practical things before you start. And these practical things start with the question of the timing. I wrote down here that you should plan enough time and start early, and on the other hand, you should start with the more proof, the better. So that's of course quite contradicting, because the more proof you have, the later it will be the stage in your company. So it's something where you should really try to find the sweet spot in terms of have I achieved something that I can actually go out with and talk about, and people will understand that it's more than just a plain idea. And on the other hand, plan enough time so that you know even if it takes longer than the 6-month period suggested, you will be able to run your business and won't be running out of money and have to close down the company. So that's something in your planning that you should think about when you do your financial plan, when you do your investment planning, that there is a sweet spot, I would say, where it's the best timing to start going out with investors. Regarding the documents, we touched this already also in the previous webinars and texts that were being published, what you actually need when you go on the process. I would say the financial plan is a must, of course, because that's the whole basis for everything. The pitch deck is a must because you have to have something in your hands if you go out there and approach the investors. The one-pager serves as an basically executive summary of the whole page, of the whole plan, and can be helpful if you want to share your idea, distribute it, send something over before giving the whole big and very detailed shot of your company. So that's not a lot of work and effort for you and can be quite useful. And the fourth, the video, is something we also talked about in the last webinar. It's under discussion because, of course, it's quite some time and also money input that you have to take there. But my experience is that it's often very appreciated by the investors because it touches on the more emotional part and will give them a better insight of your company, of your work, and also the way you deal with things. So if you have some access to, for example, a good filmer or someone who can help you with that, it should be looking professional, so anything that's just simply done with a mobile phone is probably not something that you want to take out there, but with a little effort, I think very nice videos, 2 to 3 minutes maximum, can be done here. Regarding the third point, strategic help, I wanted to list it here because from our experience, we see a lot that people often underestimate this whole financing process and also the burden and the effort that need to be taken. What I want to suggest here is 2 things. The one is that you should start, from my experience, rather early in finding some legal support and lawyer, not necessarily because you are in a difficult situation and need somebody, but when you need them, it usually has to go quickly and you want them to be on track right now. And so preparing that beforehand, having someone on board, having them in the whole process a little bit. They know what you're doing. They are aware of your financing need, and they are then able to work quickly. Is something that can be very, very helpful for you if you don't come up with that too late. And the other thing is that you actually shouldn't be too proud of thinking about, okay, I'm the one who can do that all by myself, but instead go out, take other people's help, ask people you know that know these things, or maybe more into the financial scene that you are, or more into this whole financing process idea, and just ask them if you have questions, because people often go out and try by themselves and then come back and see it didn't work, and then it's just a loss of time that you have in between. So don't be too proud, just take the help that you want and need, and you know best where your maybe weaknesses are. So just improve or give you the advice to do that. And the fourth is the mindset, not to be underestimated, because it's really a long and enduring process of where you can see that people who are too rigid in their thinking and have too high expectations on themselves and also on the whole financing process, they will have a much harder time than if you stay flexible, if you also stay relaxed, if some things don't work out, and if you are able to also mentally get you through this time in a good mood, in a good way. And you shouldn't also underestimate the whole daily business that is running parallel to your process. So before you start, think about a good idea of how you're able to lead the daily business, and at the same time focus or start with your investor search. So that's something that you can prepare beforehand, and will give you some more time and a better time. Hello, Vivian. A little bit late, no problem. Just saw the chat. Okay, so that's now the preconditions and the very good start into the investor search. Being fully prepared and with a very right mindset, we can now move the focus on the investors actually. And I want to start with a very first overview on the investor groups. Some of them might be very known to you. Some of them is maybe ones that you haven't heard before. I just want to go quickly over them, but thinking about the time, I will make it short, and if you have questions later on, you can put it in the chat. So a business angel usually is a former entrepreneur or professional who invests own money, has often a very broad range of capital, advice, network that they want to put in there, and are usually focusing on classic investments. So it can be mostly a startup, can be a social startup, but that's actually something that mostly the social business angel puts his focus on. So social business angel is pretty much the same as a business angel, but instead focusing mostly or only on social entrepreneurship topics. Something that is only coming up in the past years. So I would assume that 10 years ago, the social business angel scene was very, very small. Right now it's growing. That's the good news. It's still small, but it's on the right track. Venture capital is a term that you might know from the startup scene as well. So it's basically providing money for startups in a very high risk and high return expectation setup. So they are giving you something and expecting a lot back. But that's why for them, it's the deal starting very in an early phase, and thereby also be able to expect high return expectations. Instead of just one person, like the business angel, it's usually a pool of investors, and usually money also from institutional investors like banks, like insurance companies, loans. So it's everything rather in a bigger context, I would say, not so much individual people driven. The social venture fund works in a very similar way. So they have the same approach, that they invest other people's money in social companies, also have, compared to others, a fairly high return expectation, because they say, again, we invest in high risk companies, so we have an expectation of a high return. But compared to the venture capital, I would say it's more private investors who put their money into the social venture funds and then they spend it for them, instead of the institutional investors that are more common in the venture capital scene. The bank is a classical provider of money that you know, or most people know from also experience. It usually provides money in the forms of loans, can be very, very different in the interest rates that they expect, and can be very interesting or very pushy in their expectations. On the other side, family offices are usually financial and investment companies that are being founded by wealthy individuals. So it can be one person or one family or several families who put together their money and invest that together. What's interesting about family offices is that often you can see that it's families who have earned already quite a lot of money and are very aware of the social issues that we have in the world. So often they have money and also understand the way that social businesses work, because they say they want to do something good with it, and if they don't want to just provide it as for free money, they're moving in this in the social business, social entrepreneurship scene. Also, development of the past years, I would say, so not too old. Companies, in turn, can use the scene or the topic of investment money either as a strategic investment, so they want to have it as part of their company and support it because they see a real good idea in supporting that company in order to maybe later on take it into their own. Or they have an investment arm, which is also a development of the past years, where they have sometimes just a startup arm, sometimes a social startup arm, so they have built up more and more possibilities to put money out in the market, and some of them also touch upon social entrepreneurs. Foundations are usually founded by either a company setup or, again, families that put in their money and say we want to do something good with it, and usually focus on certain ideas of work in the philanthropic approach. So they have usually a lot of money, but usually they also have some, well, quite big hurdles that they have to overcome if they want to invest the money. So it's interesting, but there are still some technical points that make it a little bit difficult being invested by foundations. Funding matching programs is something that's usually driven from the government scene. So they are saying we want to help our market and our country to improve here, but we don't have the time and efficiency to go into details of the companies. So if you have one lead investor who's willing to go into and invest in your company, we will just match his sum. So if he gives you 200,000 euro, we will do the same on the same conditions. So we would just jump on his trick basically, and thereby help through our way to improve your company. And crowdfunding platforms is something that you probably know and have heard about, where you can share your idea, and usually small tickets are able to get the bigger sum together. To bring a little bit more structure in here, I've sorted the different investor groups, and on the line below you can see the two ends being, on the one hand, own money, rather long-term, high impact expectations and social business experiences, while on the other hand I put the opposite up and want to touch upon 4 points here. Social business angels, for example, is someone who are basically in all aspects on the very, very left side. So they are very flexible. They have more long-term aspects they think about, and usually not too much financial expectations, but rather impact expectations. A social venture fund is also very similar in the idea that they want to push the social idea forward, but they have the difference that they are investing other people's money. So on that term, it's more difficult for them to take easy decisions, have short review time, so they will be more rigid in their whole structure and approach, and usually have different committees and meetings and before they can actually give you the decision that they want to invest. Traditional and very risk averse is the bank, as you know, because they have a different system and it's not too much focusing on capital that is very risky, so they try to avoid risk, and in that context are also sometimes a very difficult partner to deal with. Family offices, foundations, and companies are somewhere in the middle, and for them it's highly dependent on the individuals and the ideas of the company or foundation, whether they want to generally approach this topic or not. So it can be very, very good source to get capital, but you will probably also take the experience that some of them will make it very difficult and are not as much into the topic already. So as you can see, we see that there are some general assumptions that you can take about the investors, and that it's very much people driven, what you see here. But we also now know that it's very important that you identify your own requirements. So whatever you are looking for, whether it's long-term or short-term, and what your expectations are in the context. And also that you keep in mind that although it's one investor approach, you should have different approaches in whomever you're targeting, and anticipate their behavior and their expectations on you, because then you're able to give the right answers, tell the story in a way that you know they understand and they like it. Okay, now how do you actually get in touch with investors, or where, and what is useful? Looking at the time, I will not go into the very details of the events on the left side. I think most of them are very self-explanatory, and you probably have heard many of them already. What I want to do here is just give you again an overview of that, an overview of the fact that they're very, very broad ideas of where these people can be found. And I meet a lot of people, social entrepreneurs, who come and say, well, I don't know where to find them and where to go. But honestly, you do know it, and it's really about the creativity, and also the part where you just sit down and Google and look for them and find the right associations, events, universities that fit to your idea and are close to your neighborhood. So, for example, the pitch events is something that is totally rising in the past months, because it's a very simple styled event where you have the 5 to 10 minute pitch, and potential investors sit there and listen to your story. And that's something that you can do with very minimal effort if you get to one of these pitch events. And it's something that you never know what comes out of it. So it's always useful to, that's the right part, what is useful, to go out and tell your story, and also not expect or just go and take every opportunity, because after all, you don't know who's sitting in the plenum. Maybe if you don't even talk to an investor, it's someone who might know someone who would like to invest in these kinds of ideas. So don't be too focused in the beginning of finding this one investor who will just love your idea, but instead try to be very broad in your approach. That's something I want to give you, because I see that many people are trying to be too focused down on just one or two ideas, instead of really taking all the opportunities out there. And I think what you should do in conjunction with that, being broad is the one thing, but then if you find good investor opportunities, narrowing it down. So also doing good research on the web pages, informing yourself beforehand in the focus that they're setting and criteria they have. So what most investors don't like if they have a setting of criteria, and you just jump in there with your own approach, which maybe fits or maybe doesn't. So really try to find out what they're looking for and what your best best arguments are, and then approach them directly with this very strong and very clear pitch of your idea. Building up your network is something that you should be starting as soon as you start your investor process. So really trying to find the right people, also connect other people, because at the end they will then help you getting better with your and getting further with your idea. So that's really, take it as a process, and take everything which is out there to improve your way, because that's after all the most likely event that you will see and find something. Also, publicity, of course, is helpful. So whenever you have the chance of someone writing an article, also using social media if you have a good project. So it's always helpful if other people have heard about you already or have discussed you somewhere. That's something where you can click on and maybe get a good intro. I've also listed some sector relevant events and organizations here. I think it's well, very small overview, but just to also give you some concrete examples. Green Tech Capital, for example, is a fairly small and new company. They empower impactful startups in sub-Saharan Africa with a range of capacity building and network events. So it's also something that starts as maybe a capacity builder, where you say, well, is that actually something that I need? But just taking that as an example, if you go in there, get in contact, maybe it's something that's suitable for you, and then they have an event, and then you're part of the event, and then you meet an investor who might be someone who's just the right person for you. So really seeing opportunities in many of the organizations or events that might not be the perfect fit for you is something that I think is very good to be open-minded here. The Foro Latino America is the largest impact investing gathering, for example, in Latin America. Can be useful, can also be quite, well, a waste of time for you if you don't meet the right person. But at the end, I think it's always a cost-benefit analysis for you to say, how important is it for me to meet other people right now? In the beginning, it's most often the time where you should meet many people, and then you can focus it down during the course of the process. The European Venture Philanthropy Association, as another example, is an event that's coming up every year, and there's a lot of impact investors, a lot of foundations, some companies, some social entrepreneurs. So it's really a broad forum, and using these opportunities to meet people and to pitch your idea is something that I would definitely recommend to you. Now, looking a little closer at the investors and their expectations. I think the investor expectation is very depending on the kind of investor, and also their degree of professionalism themselves. Some of them are, very structurally organized and are very well, themselves professionals in this whole process. And some of them are just individuals, a little bit like you and me, with more money that they want to invest. And they will, of course, be have different expectations. Nevertheless, I think the 4 points that I put down here is something that refers to all of them, and is something that you should take as a guidance in your preparation and in your pitch events to the investors. The aspect of professionality is definitely very highly ranked, because even if in the social entrepreneurship scene, I can see from all the investors, every single one I meet, is that they like you because you are focusing on social topics, but they also like you because you're doing it in a very well-structured, professional, and good way. If you would do it in just a side project and don't take it seriously yourselves, they would think about spending their money to someone else because they see that for you it's just a topic that you do on the side. So really having this focus yourself and this long-term view of where you want to bring this project and your company to is something they look for. What's in for me, it's always the question that they are asking themselves, and that's a question that you should have in mind and be able to answer. Because at the end, it's not exactly about you and your company, but it's about what it does with the investor when he provides you money. A good idea and a strong team is always the two aspects that are named as the main points when investor decisions are taken. And honesty and authenticity, I wanted to put down because from the pitches I see and from the people I meet, I can tell that most decisions are taken in a positive way if the team and their presentation is authentic, and if they really mean what they say, and if they're not telling you stories on big dreams, but also telling you stories on how they want to achieve these dreams and how pragmatic they approach them. So this brings along a good preparation on your side, including or starting with a good pitch deck, which has a storyline, which is something that people actually find themselves in if they read it, by practicing a lot. So presenting your idea, presenting your pitch to others. It can be professionals on the topic, can be someone who's just focusing on your voice and your verbal presentation. So go out and really try to find as many people you tell your story to. That's also mostly the point where you can see that you find some trigger words, so examples of phrases or catchwords that you say where most of the people you tell to are like, okay, yeah, this makes sense, or this is great. So finding exactly these phrases, how you put it out, is something that's very helpful in the preparation, because it will bring you good results at the end. Testing the technical setup beforehand is a very simple but very, very important part. I've seen it too many times that people come in there and presentations don't work and investors get annoyed. So whatever, most often it's very possible to try it beforehand and really think about or remember doing it, because that's something that's little things that can be very annoying for investors. Try to meet in person instead of phone. Also, not always possible, but something you should try to do, because this personal interaction, as you know, is always has a better impact and a big trigger to a positive outcome. Preparing for tough questions is something we will look at the next page. And two more points on the follow-up and project management capabilities. That's considering the point that the whole way you behave in this investment process is also decisive for the investor to say, yes, I want to invest, or no, I don't want to invest. And that's something that runs totally on the side and is also very individual of whether you're a good management capable person or not. But you should have in mind that, like, these small things, by being on time, being reliable, being precise, it's something that an investor will look at, although it has nothing to do with your idea, but of course with your company and the way you lead it. And not changing your opinion too quickly is an experience I've also seen in many presentations, where social entrepreneurs will be being asked by investors on difficult questions. And I've seen that many people in this situation change their opinion, they give in. If the question is, well, why are you expecting your revenues to grow by 20% in the next year? Then the immediate reaction is, well, maybe this is too ambitious and maybe I should change it. And maybe, yeah, you're right that this is not realistic. If you know that you're wrong, you can say so. But if I would suggest, and my understanding is that you've put a lot of time and thought in establishing your plan and in building your whole financial framework. So in this situation, I would encourage you to argue your plan and to say, well, I expect that I have bigger revenues because of ABC, and in this context, that's the figures that came out of it, and I have good reason to argue this. Maybe you have a different opinion, and maybe there's something right on it, and maybe I will go over and check again. but don't be too quick on giving in and giving rights to the investor, because at the end, on the investor side, I will also want to experience a person who is strong in their beliefs, who is strong and has a good understanding of the own abilities, and isn't someone who's just running after my opinion. So find a good match there in between, but I think it's something quite helpful to think about also beforehand. Now, the almost last page on common investor questions. I've listed a couple that I heard quite often, and it's something that is just a very first glimpse of what you can expect. And of course, there are many more and very creative questions, but these are just a couple. The question of why you raise the money and for which purpose is always being asked. So I'm sure you will have an answer to that, but make sure it's a good one and that you know exactly, especially the purpose, to be able to explain in a good context. Also, this question here, how much work lies with the founder, is of course focusing on the whole team aspect. So remember to pitch your team and not yourself. Of course, it's about yourself. And it's important that you are able to bring that message over. But for the investor, at the end, it's the team and the whole group that is relevant. Because if you, for some reason or the other, are not able to work tomorrow, then the investor is very interested in the fact that the company runs without you. Regarding the financials, I think the most important point I want to make here is the assumptions in your financial plan. Because if you build your financial plan, you should keep in mind that it's not about putting one hard-coded figure in there and then tell a story about how you came to it, but instead build your financial plan based on assumptions. That means you have your system of your revenue drivers, so the product price, the product, the volume that you're selling, etc., and then have a good argumentation on why you believe you have this is the correct price and why you believe this is the volume that you will sell, and then build it up by that. And in doing so, you're able to argue on the different assumptions that you have. And assumptions can, of course, change, and you're able to change your financial plan with it. But it gives you also the ability regarding the investor to argue on one point of this whole financial plan and not just the financial plan in sum. So make sure you have enough flexibility in your plan where you can argue, okay, if I open up another store, then of course these figures will all change, but they will change not because of one reason, but because of several different reasons. And the other maybe important question here is the last one, on the plan B. So you look for a certain amount of money. In case you don't get it, what do you do? And it's something that's not very uncommon. And so the question is very valid, I think, and you should be prepared for yourself anyhow, but also for the question in arguing a good plan B. Regarding the special questions, I think the part on the impact is something that is being asked more and more by the investors that I meet. It's about being able to determine your impact and be able to measure it, because at the end, investors want either the financial return or they want just a social return, which is then the return on what you achieve with your with a group of people, for example, you're working with, or they want a combination of both. And if they want a combination of both, it basically means that you have to be able to measure the impact that you achieve, because that's the only way you can put it into one whole return figure on the financial and the impact. So what does it mean? It means that your KPIs, so your key performance indicators, should be clear to you. It can, for example, be the number of kids that you reach with your offer, or the number of trainings that you have. So something that's really tangible and quantitative. And with that, you can show the investor that you measure your impact. You can give him an answer on where you want to go and how you can put that into your investment plan. Yes, so much to this. It's also being recorded, so if you want to have the opportunity to go through the questions again, you can look it up later on in the recording, because it's quite a lot I see. Okay, and that's basically already it, and we just have some key learnings here listed up that I quickly want to go through before you can take the questions. First point, definitely take enough time, plan enough time, because it's always better if you have some room for maneuvering than by standing with your back against the wall and also having to tell the investor, if you don't provide me the money in the next 4 weeks, I will have to close down my company. Number two, think in advance what kind of investor you have, so what you need, what your expectations are. That's also regarding, on the one hand, the financial parts, on the other hand, the whole topic of network, of input, of exchange that you want. That can be quite different. Number three, prepare yourself with all the relevant documents, practice your pitch, make sure you have the whole spectrum of things that you need in a very professional and audit way ready, because that's the bag you need if you go out there and talk to other people. Use every opportunity to meet investors, so don't judge too early on whether he or she can be helpful for you or not. Look for opportunities and be open for many changes. And that's the last advice, number 5. Be professional and creative, yes, definitely, and always expect a turn of events, because there are very many that experience it in a positive way of finding early someone who's providing the money, and also experiences and examples where things that look to be finished up already and agreements that seem to be done somehow loosen up, and you stand at the very beginning again. So don't get frustrated, stay positive, and be convinced if your idea is good that you will find someone who will invest it. But if you're prepared for changes, it will be much easier for you to go the way. All right. Now, sorry, I ran a little bit over time, but we have time for questions now. You can write them in the chat function, because unfortunately I cannot hear you. Any questions? It was so crystal clear what I told you. I can't imagine. Are we already in the investment process, or are most of you still planning? Or maybe about investment sums while you're writing. I didn't talk about investment sum or the actual figure, because it's very, it's really, really broad, and it's nothing that you can focus down. Although you can say that we differentiate between different phases, and what we talk about, or what I talked about, is the early investment phase. So usually it's the earlier the investment phase, the lower or the smaller the investment sum that you get or that you look for. So it's something I would say in the beginning, starting at 50,000 maybe, and then growing to 500,000, which is quite a sum for the first phase. And then if you grow older, and if you have a second round and a third round, then it can be more money, but usually you start with smaller tickets in the beginning. Monica's asking where we find the presentation. It's on the Empowering People Network website. Maybe we can post in the link here. I did it the last time as well. Sabine, maybe you can just copy the link where the information is posted on the website. we'll do that. Perfect. Any more questions? No questions today. We are interested in the funding matching programs or a loan from a foreign bank. If loan from a foreign bank, I must say I'm not the biggest expert, so I can't talk too much about that. About the funding matching programs, I think it's a very great idea and it's a good opportunity. There are by now quite a lot of programs that are out there, and they're changing also, more coming that are being used by people. So I think what is important that you look for the conditions they have, because the conditions can vary quite a lot, and you want to make sure in the beginning that it's something that suits to you and your expectations. It's then most often the case that you need some kind of lead investor, because most programs, as I said, focus on the idea that they don't spend too much time themselves, but instead find someone who is who they trust basically as an investor, and then go hook a pack on them. So that's the way most programs work. Some of them will match the exact amount that you get through other investors. Other programs have their own investment sum that is fixed. So most of them are quite working quite well. So I think it's a good opportunity if you have some other investors that are following, that you can take them in. What you should know about these matching funding or matching programs, just to be aware of, is that they usually won't give you too much input or external advice. So if you're a company who's looking for someone who's also going in there as someone who discusses with you and maybe brings some good ideas and helps you to develop your company, they won't probably be the number one on that list, but you don't necessarily need that, and so I think it's a good opportunity. Okay, if there are no more questions, we will end this here. I very much thank you for participating, and I hope you learned something, and I wish you very good luck on your investment processes or whatever process is next up for you. Thank you for joining. Goodbye.